family. Today, we got a lot of stuff that we need to get into. Yesterday, the market action did not make sense at all. Inflation came up 0.4% higher than expected, and yet the market rallied. All three indices were up a lot, not just a little bit, they were up a lot. What could all this mean? We're going to get into some stories, talk about what the possible repercussions of that market action could be. And I want to know, before we even get into that, what are you guys thinking? What's been on your mind? Are you guys nervous right now? Some of the people that have contacted me and have commented below, they're showing some nervousness, and I totally understand. It's a crazy environment, but that's why I'm here. So I can learn from you, you can learn from me, and we can get through all of this together. Before we get into all the stories and all the charts, drop a like below. I really appreciate when you guys do that, and subscribe if you have not subscribed to the channel so you get more content like this. With all that said, let's get right into it. So the first thing that we're going to look at, as always, is we're going to look at what the market is doing right now. It is currently 1:32 p.m. Eastern Standard Time, and the Dow is currently down 0.89%. You have the S&P 500 that is currently sitting at 1.70%. You have the NASDAQ sitting at 2.20% down on the day. And this was after some crazy action yesterday, because the market actually rallied when it should have been going down. But one thing that I did look at that kind of told me that we were not safe just yet was the VIX, the volatility index. We're going to take a closer look at the volatility index, and I'm going to tell you guys why I was not tricked yesterday when the market was up after horrible news. I mean, it's not horrible, not atrocious, it's not the end of the world, but there was negative sentiment that was going on. So we got to get into that. Gold, my friend Matt and he's been on the channel a bunch of times. He's kind of a fan favorite. We were talking about gold yesterday, and it's not acting the way you would want an inflation hedge to act. But his take is that, it's a currency that has been 500 years a store of value, and like over 500 years. And since the beginning of time, it has been something that people have fled to when a lot of other reserve currencies have failed. And, he's not wrong about that. So gold is really, really attractive right now. But I wouldn't jump into anything 100%. Nothing. There's not one asset class that I would jump into right now. Let's look at the crypto market. So the crypto market, you currently have Bitcoin slightly down on the day, but is hovering between 19,000 and it's staying below that $20,000 threshold that has been a psychological level. For Bitcoin, if we hit under 1,800, that's signs to worry. The next level down for that would be around 1,500 as a level of support. So keep that in mind. We are over the $1,200, $1,300 range for Ethereum, but anything under 1,200 is short-term buyable. But in the next 6 months, I could see us going to like 600, and that would, to me, would be a buying opportunity right there. Obviously, it could always go lower, but we're thinking long-term here. We're long-term investors. All right, so let's look at the rest of the market. What is up today? We have the market movers are U.S. Bank Corp, Wells Fargo, Delta Airlines, JP Morgan Chase, Norwegian Cruise Lines. Those are the ones that are up. Some of the banks are up today on good news, but Morgan Stanley had some negative news, so they are down right now. Then you have First Republic, Mosaic, CF Industries, Charles Schwab. Let's take a look at the NASDAQ. We got Splunk up, Comcast is up, and they're all slightly up. But when you look at the stocks that are down, you have Mercado Libre, Lucid Group, Zscaler, Tesla. These are all down over 5%. And the ones that are up leading the NASDAQ are slightly up, not even 1% up. So that's a big sign right there. You have the Dow. JP Morgan Chase is up, as we talked about. You got Boeing, Verizon, Johnson & Johnson. There's not even 5 positive stocks in the Dow Industrial Average today. The bottom, they're not really getting crushed like 5% like the NASDAQ, but you have American Express, Apple, Caterpillar, Chevron, and Dow are leading the Dow Industrial Average down. All right. So what I got pulled up right here is a chart from the S&P 500. It's a monthly chart. Looking at it on a daily, these are daily candles on the monthly chart, and you can see we've been trending down. All right, let's take a closer look. The last 5 days. This is a 5 minute chart. Let's change this. We could do like a 1 hour chart. This is a 1 hour chart in the last 5 days, and there you go. We haven't really moved up or down in any serious form of fashion. Um, that's something to keep an eye out right there. We'll go to the 1 day chart, and we'll look at the, let's say, 10 minute. As you can see, we've been like a staircase down. We were up at the open, and ever since then, we've kind of been bouncing up and down. There's not a lot of buyers in the market today. A lot of that got expended yesterday. And why is this? Why did this happen yesterday? Well, there's a lot of different things. There's a lot of different reasons that this could have happened yesterday. And one thing you need to take into account is that there are people that sell options. All right. When they make a bet and the bet does not go wrong, a lot of the times these big institutions don't buy hundreds and hundreds of shares and do the options like that. What they do is they try to make money out of thin air by purchasing a contract from somebody else and just borrowing 100 shares and loaning and using that to gamble. Now, when their gamble does not go the way that they wanted it to go, now they have to actually go back on the market and purchase the shares no matter what prices they're at. When this happens, that's when you see a lot of green days like this on bad news, because a lot of people are doing something that is called covering your shorts. If you know anything about Wall Street bets, this is one of the things that they were betting on. They were betting that the short sellers would have to cover their bets. And when they went to cover their bets, that would make the stock shoot all the way up. And obviously that did happen. And that's what I think happened yesterday in the market. That's why the stocks were up, even though the rest of the news around the globe has not gotten anything. Like, there was no fundamental news that was released yesterday that was anything to be relieved about. All right. So let's get back into all of this. Next thing I wanted to look at was the VIX, the volatility index. Again, I told you this is something that I'm looking at, and this is something I keep a very, very close eye on because the VIX is very, very important. All right. Let's take a closer look at it. Let's look at a 1 year chart on the VIX. Let this thing load. Matter of fact, we'll do a 6 month chart. As you can see, we bounced up and down right here between May and June. And then that's when the stock market started going down. And then you see the VIX going down as well. You know, there was some relief. Matter of fact, let's look at the 3 month. As you can see in the 3 month chart, the volatility index, which is not something that you want up if the market is going up, but it does kind of anti-correlated to the market. When the S&P 500 is up, you usually, not necessarily have to, but you usually see the VIX down and vice versa. But what we're seeing is short, choppy moves on the way up. And this does not make me comfortable to drop a lot of money into something like this. I don't want to see this if I'm dropping a lot of money. What I want to see is a big spike. Now, if we go back to the all-time chart, you can see that there has been times in history when we have seen those big spikes. You got the dot-com bubble, you have the housing market crash, then you have the COVID lockdowns. So we have seen the VIX spike a lot, and those have been times to jump in. All right. One thing, we do got to talk about, and let me pull it up right now, the SPX chart. Let me pull this back up because I want you guys to put this in perspective. All right. I want to take you guys to the all-time chart of the S&P 500, and I want you guys to look at this because this is very, 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 very important. All right. If you came in around 2010, 2011, all you've seen is the market go up and up and up and up. Prior to that, if you had invested during the dot-com bubble, all right, let's say it closed here. Let's say 1498, right? 1498 was the highest I could find right here without taking a really, really close look. The market did not reach that time again. All right, that 1498 happened in the year 1999. It did not reach that point again until, let's see, for 1500, let's call it. It did not reach that point again until 2007. And even that was a false top because, again, the housing market crashed. that went down again, and you did not actually hit that 14 something mark until about 2012. So that's about 12 years where the market did not really move up at all. There was no all-time high reached again. But if you were smart, you were buying throughout all this time. That way your cost basis wouldn't have been 1498. By the time you got back over here to this 1440, 14, let's call it 1569 in 2013, your cost basis would have been probably around $1,000 if you would have been buying this whole time, maybe even less, depending on how much you bought during the times when it was really, really low. As you see here, the low on the October of 2003 was 995. So if you bought a lot during that time, that would have brought your cost basis down. All right. So that's one thing you guys want to keep in mind. What is my cost basis? And staying in the market is a healthy thing. Imagine you pull out and then you're going to regret it later on if you haven't been dollar cost averaging throughout the whole time. So I just wanted you to take a look at that and know that the market just doesn't go up. You know, there's things called dead decades, and there's a lot of people predicting that we can go into something called a dead decade. And that's not something to necessarily be scared about unless you need that money back in the next 10 years. All right. When we're investing here, we're investing for generational wealth. People that were investing back here in 1997, yes, they went through a bunch of big crashes, but if they were invested this whole entire time, they made out like bandits, especially if they were investing in some of those tech stocks that are like the biggest companies in the world right now. All right. So do your research, go out there, try to find the next Tesla, try to find the next Apple, Facebook, all these companies that reach that $1 trillion level. All right. So some news. Here's how rare the S&P 500's violent reversal was after Thursday's inflation report and what history shows may come next, according to Bespoke. And this is just something that is covering why it was so weird that we got that market action yesterday that made absolutely no sense. Why would the market be up on a day when we got news that the inflation report was up 0.4%. So let's see what they're talking about here. The US stock market took an unusual swing after Thursday's inflation report. And it was very unusual because pre-market, when that news came up, the Dow, the S&P 500, the NASDAQ, they all dropped like a rock. But when the market opened, they were up. It was like a 700-point reversal. All right. And that's very, very strange, especially on bad news. Shortly after the open, the S&P 500 index had dropped nearly 4% from its pre-market highs before staging an epic rally of over 5%. Even in this all or nothing type of market environment, reversals of that magnitude are rare. Stocks opened sharply lower Thursday as investors assessed the report from the U.S. Bureau statistics showing that inflation in September, as measured by the CPI, the Consumer Price Index, was hotter than anticipated. All three major stock benchmarks, which we talked about, later reversed course, erasing losses and finishing the day with earlier gains. There were only 9 other days in 1983 when the S&P 500 fell more than 2% intraday, but finished the day up over 2%, said Bespoke. The most recent occurrence was over 11 years ago on October 4th, 11. And before that, there were 5 separate occurrences in 2008 alone. And here, if you look at this chart, that's when they happened. So let's take a look at this. It happened here right before rally. Okay. How long was this rally? It was about, if this was 1997, then we had what, 5-year rally here before a big drop, but it happened again right before a rally. It happened right before a big drop. It happened in the middle of a big drop, and it happened again right in a rally. So because you get this signal, it does not necessarily mean that the market is going to keep moving in a certain direction, because here we have 1, 2, 3, 4, 5, 6, 7 instances where it dropped, and then you have where it went up, and then you have 2 instances where the market dropped. The chart above shows the remaining large reversals were in 1987, 87, and 2007. We're not sure when or where the ultimate bottom in stocks will be, but violent moves like this tend to occur closer to lows than highs. It's been a tough 2022 for the stock market amid investor anxiety, which we all have a lot of reasons to be anxious over the Federal Reserve raising interest rates to combat high inflation. The S&P 500 has tumbled around 24% this year based on midday trading Friday. The performance of the S&P 500 after swings of Thursday's magnitude have mixed results over the short to intermediate term. 1 year later, though, performance was much more consistent with an average gain of 14.6 and the median being 19.4% and positive returns 8 out of 9 times that happened. People usually forget that long-term rallies emerge out of chaos where investors become increasingly convinced that the only viable path, if any exists at all, is lower. So some good news there. You're seeing that these signals we received a year later, the stock market is usually up. That's basically the so what from that article. So let's talk about some cryptocurrency news. Bitcoin's reverses lower after Thursday's big rally, but remains slightly above that 19,000 level. And we covered that at the beginning of this video. And cryptocurrencies continue to climb on Friday as investors sought to extend the previous day's rally. Bitcoin was lower by less than 1% at 19,286, and Ether gained almost 1% to trade. And it jumped on Thursday along with the rest of the stock market on a high inflation report, which again did not make any sense. Yesterday, we saw a knee-jerk reaction. Keep that in mind, knee-jerk reaction lower in all markets, which was algo driven. Also, that's another something we haven't talked about. Another reason that it jumped up. Then short covering and real buying. We talked about the short covering, and then real buying stepped in, which was the right response to the CPI data. Chief Investment Officer at ARCA. Markets aren't concerned with inflation. They are concerned with the Fed's expected response to inflation, and nothing changed yesterday. 75 basis points was baked in, and it was confirmed by the CPI data. October tends to be an up month for Bitcoin, according to Bespoke Investment Group. Bitcoin has never been in a bear market like this one. However, some remain cautious. And the last thing we're going to look at today is the fear and greed index. And currently, we are sitting at extreme fear with a number of 22, but I want to see it lower if I'm going to be a big buyer in this market. I want to see it a lot lower. I want to see it in the 15s and the 10s, something like that. This is still too high for me to make any big moves in this market. All right. So just keep that in mind. There's extreme fear in the market, and there's a lot of signals pointing there. We're under the 125-day moving average. We have net new 52-week highs and lows on the New York Stock Exchange are the lowest they've been this year. So there's a lot of reasons to be skeptical. And what did Warren Buffett say? Be greedy when others are fearful. All right. So yes, this is a time to start being greedy, so you can start making your list of exactly what you're going to be buying in these markets. But this is not a signal for you to go all in, because the S&P 500 can still go a lot lower, and it could go as low, like there's no limit to how low it can go, depending on the news that we get. Like we can get something horrible, atrocious could happen, and that's why it's always good to have what we call dry powder. Have that dry powder ready to go, so you can deploy it whenever it's time to make a big investment, and you're not fully invested having to sell things in order to buy other things. You have that money sitting on the sidelines ready to go. I am not fully deploying any money into the real estate market. I'm not deploying a lot of money into the crypto market, the stock market. We're doing it little by little when we see great opportunities. All right. So as always, I want you all to tell me in the comments below exactly how you're navigating these treacherous times, because I understand there's a lot of treachery in the market. A lot of people are confused, and I understand. And sometimes the best thing to do is do nothing at all and just be patient and wait. All right. There's nothing wrong with that. So thank you for watching. If you made it this far in the channel, as always, invest in me and press that like button, invest in yourself and smash that subscribe button. It costs you nothing. Until next time.